Are your trading biases costing you money? Imagine making a decision that feels right at the moment but ends up costing you a lot more than you expected. That's often how biases sneak into trading and affect your results. When you review your trade performance, you might notice patterns that aren't just about market moves but about your own thinking. These biases can make you hold onto losing trades longer than you should or jump into trades based on emotions rather than facts. Confirmation bias is a common one. It's when you focus only on information that supports your current idea and ignore signs that suggest otherwise. For example, if you believe a stock will go up, you might only see positive news and overlook warning signals. This can lead to bigger losses because you're not seeing the full picture. When you review your trades, look 4 times when you ignored evidence that didn't fit your narrative. Anchoring bias is another trap. It happens when you fixate on a specific price or target and refuse to adjust even when the market changes. Say you bought a stock at $50 and set a sell target at $60. If the stock drops to $45, you might hold on because of your original plan, risking more losses. Reviewing your trade history can show if you're holding onto positions because of past prices rather than current market conditions. Recency bias is when recent events influence your decisions more than they should. If a recent winning streak makes you overly confident, you might take bigger risks that don't match the current market. Or if a recent loss makes you overly cautious, you might miss good opportunities. When you analyze your trades, check if recent wins or losses are skewing your judgment. Herding bias is when you follow what others are doing instead of sticking to your plan. This can cause you to buy at high prices or sell in panic. Reviewing your trades can reveal if you're influenced by crowd behavior rather than your own analysis. Loss aversion is a big factor. It makes you afraid of losing money, so you might close winning trades too early or hold onto losing ones hoping they'll turn around. This can hurt your overall gains. When reviewing, see if your emotional reactions are causing you to make poor choices. Negativity bias is when you focus more on potential losses than gains. This can make you avoid taking trades that could be profitable or cause you to hesitate. Check if fear or doubt has kept you from acting on good setups. All these biases can mess with your risk management. For example, ignoring stop-loss signals or setting them too tight because of anchoring can lead to bigger losses. In options trading, biases might cause you to overestimate volatility or hold onto positions that no longer make sense. The key is to review your trade performance regularly. Keep a journal of why you entered and exited trades. Be honest about whether emotions or biases influenced your decisions. Set clear rules for trading and stick to them. Seek feedback from other traders or mentors to spot patterns of bias. By recognizing these tendencies, you can start making more rational choices. This helps you manage risk better, avoid costly mistakes, and improve your overall trading results. Remember, the goal is to trade smarter, not just more.